Right, let's expand the conversation. Professor Andre Roux, economist at Stellenbosch Business School, joins us for that. A very good evening to you, Professor. Thank you for your time. How best should we interpret the downward trajectory?
Yes, I think your introduction has stated the case very clearly. It's obviously, it wasn't totally unexpected. It's obviously gratifying that it is now well below the midway for the time being of the target range. And we know that the Reserve Bank and the government in particular has implicitly focused 4.5% as being his real target and the anchor for lower interest rates. So I think I agree with your previous commentators. We can certainly look for a 25 basis point drop in the next Monetary Policy Committee meeting. Perhaps not a full 50 points. The Reserve Bank and the governor tends to err on the side of being conservative. And we do note and we do see that the oil price internationally has moved upwards a bit. The rand is not quite as strong as it was a month ago. And indications are that actually the petrol price might go up ever so slightly on the first Wednesday of November. But for now, I think we are firmly entrenched at or about, for the next number of months, the 4.5% midway level.
Yeah, and insofar as getting ordinary day-to-day consumers to understand the impact, what approach is needed for that level of understanding and depth and what this really means?
Yes. Well, I mean, we must bear in mind that the fact that the inflation rate is moving downwards does not say that prices are moving downwards. Generally, prices are still rising, just at a slightly slower rate than before. Also bear in mind that the inflation rate, the one we're talking about, is based on a basket, as they say, of a whole bunch of goods and services, many of which are not bought by all consumers. It also makes the assumption that the weighting, as they call it, of each item remains constant over time. And by implication, everyone's weighting is the same, which is also, of course, not true in reality. So the fact that, for argument's sake, the price of alcohol goes up by whatever percent only affects those who drink alcohol. For those who don't drink alcohol, it makes no difference to the inflation rate. And we can say the same for many others. So it must be seen as kind of a benchmark, as a gauge, as a dipstick almost, for the average price level. But each person's inflation rate could differ quite significantly from others. And I think on that point, I want to say that over and above the so-called headline inflation rate, there's a whole bunch of other rates that are calculated, including 10 inflation rates per income or expenditure decile. So households are divided, number of households, into 10 equal portions, ranging from poor households to more affluent households. And for those classified in the first decile, with the lowest spending per year, barely 20,000 rand per year, their inflation rate is well over 5%. It's around about 5.6%. So, and for those in the upper decile, it's somewhat lower. So I'm afraid the reality is that for poorer households, inflation is worse than for more affluent households. And that's probably because food is such a big part of their basket. So for poorer households, the news is not so good as for the overall situation in the country.
The possibility of an upcoming interest rate cut, what opportunities does that, in terms of planning, perhaps leave for those who may be indebted, those who have bonds? Is there any room at all that could lead to some form of negotiation?
I'm afraid, yes. Well, first of all, yes, there always is. Anything helps. I mean, financial advisors would probably say that even though your bond payment might fall, try to retain the payment you've been making thus far. In other words, you end up paying more than you need to in terms of the new lower interest rate, and thereby cutting back on the ultimate period of repayment. But we must bear in mind so many households are cash-strapped. I think a recent survey shows that a very large percentage of income-earning households are living from hand to mouth, are running out of funds towards the end of each month. So that means there's very little wriggle room for any kind of savings. Unfortunately, lower interest rates are also a deterrent to savings, of course. But ideally, use the opportunity to pull down any outstanding debt. while you can. And of course, also, hopefully, we haven't seen the last of interest rate cuts. We'll see another at least 25 basis points in November, and probably another one in the next Monetary Policy Committee meeting. And then if inflation behaves itself at or about 4.5%, we could see one or two more cuts. Bearing in mind, as I say, there are so many risks, especially globally. Fuel prices, oil prices, food prices, climate change, geopolitical risks, politics, 64 elections this year, a US election coming up in a few weeks' time. All of these could again put upward pressure on inflation. But for the time being, the combination of low inflation, softening of interest rates, bear in mind the fairly stable exchange rate, bear in mind there seems to be an uptick in consumer confidence, driven at least part by our government of national unity, which is deemed to be by the market to be market and business friendly. Bear in mind that there are some commitments for the first time in a long, long time for fixed investment, especially foreign investment. So the overall climate is slightly more favorable than 6 months ago, but one swallow doesn't make a summer.
Yeah, absolutely. With the many risks, there is still some glimmer of hope. Thank you very much, Professor Andre Roux, economist at Stellenbosch Business School, just helping us unpack some of the good news, I suppose, still to come. Consumer inflation continuing on a downward trajectory, and of course, what's expected in the later months.